Thank you, Regina. Good morning, everyone. My name is Ali Rutarindwa Muvunyi from the newest member of the IDFC club. I'm really happy to be here. Likewise, as the bank is new in the IDFC, I'm also new at the bank. I'm turning 2 years tomorrow. So maybe if I can start with a bit of introduction and background on BRD. So BRD has been in existence for 58 years now, and it's the only public development bank in Rwanda. And its main mandate is to support the private sector by providing affordable and long-term financing through on lending through to other financial institutions such as commercial banks, microfinances, and also what we call the SACCOs, the savings and credit cooperatives, and to empower them to contribute to the national strategy transformation. So we are now currently at the NST2. NST1 was from 2017 to 2024. Now we are going to be having a 5-year national strategy for transformation. And our main areas of intervention are about 7 or 8, including agriculture financing, education, housing and infrastructure, energy, of course, export and manufacturing. We're also recently embarking on digital economy and also social infrastructure. So when it comes to a project or a program that we do that deals with mainly blended finance, we have what we call Ireme Invest. So Ireme is a local language name that means sustainable. And it's the Rwanda Green Investment Facility that is sort of use blended approach to finance projects, from resource mobilization, a blended approach on resource mobilization, and also in terms of financing projects. The reason why it was created is through different strategies, visions, such as the Vision 2050. So the country intends to be a carbon neutral and climate resilient economy by 2050. We have the NST2 that I mentioned. There's the Climate Action Plan, or the NDC's contribution, which are quite stringent, if I can say, because we committed to reduce at least 30% of our emissions by 2030 against the 2015 baseline. And there's also a green growth and climate resilience strategy that was adopted in 2011. And the challenges that this facility or this program is doing is to first to solve the issue of lack of access to finance for green projects. This includes high cost of fund, of course, limited track records in terms of green projects financing. There's also another important challenge of high risk aversions from commercial banks or other financial institutions that are not really, do not have appetite to finance green projects. And there's also high collateral requirements for mostly startup projects that are investing or exploring green project. As well as also the lack of technical knowledge to identify or screen or also finance green projects, because sometimes we do also see a high risk in terms of greenwashing, because you find that many developers are coming in with what they think is a green project, while it's really not a green project. So the Ireme facility was created to kind of be a catalytic kind of instrument that will drive the strategies and goals that I've mentioned earlier. So from the immediate investment opportunities, we identified 5. Again, given the current economy and priority sectors, these include clean energy, which makes up the significant portion. And there's also smart mobility, sustainable cities, climate smart agriculture, and also a new component of waste and circular economy. So in terms of the blended financing approach, in terms of fund mobilized, we have mainly three components, including credit lines, grants, and also bank guarantees with total commitments. So apologies, not funds mobilized so far. These are committed funds. We have a total credit line commitments of $210 million from different partners, from donor funders, as well as from the public sector, and we also have grants and also bank guarantees. So the total current commitments account to 260 million that we are sourcing from different partners, including what we see on the screen. And also in terms of financing now, green projects are also doing a blended approach where we are partnering with the Rwanda Green Fund. It's a public institution that finances green projects. Initially, it was mainly involved in public sector investments, but now through Ireme, it's going to be specifically for the private sector. So we are doing, depending on the project level or project readiness, the main goal is to support a project from the ideation stage up to scaling or widespread scaling of the project. So with that, we have two main instruments. There's the project preparatory facility, which is being implemented under the Rwanda Green Fund, that provides a grant that are also under two categories. So there's the pure grant and also the recoverable grant. So the pure grant is for mainly these new technologies that are not really well used in the market. So people who are trying to do feasibility studies, or want to do a pilot, a proof of concept, they can go to the Rwanda Green Fund and tap into the non-recoverable grant to carry on these studies and feasibility. There's also the recoverable grants for mainly already established businesses that also want to try a transitional approach for new technologies. They can also get a recoverable grant that is paid with around 3 to 5 years to kind of make a proof of concept of that technology for the transition. There's also a component of equity investment for mostly startup businesses that are not really that would really need equity investment, and the approach also is to support them to become more self-reliant in terms of their operations, because once the Rwanda Green Fund provides an equity, they also discuss on the exit kind of approach, and also they become the minority shareholders in terms of to support these businesses to be able to be sustainable. And on the side of BRD, we also provide two types of blended instruments. There's the concessional loans. So in terms of the concessionality, if I can give examples, so the current financial market, the interest rates average between 17 to 18%, but the concessional loans we are providing they are around 12%, which is quite significant. And the most challenges that we've faced is in terms of to unlock the financing to this project, they also need collateral requirements. So we also provide collateral, partial credit guarantees through collateral support, not only to unlock financing, but also to kind of de-risk this project. So this is the approach that we thought was best, also tailored to within the Rwandan context. And so far we've seen quite significant progress. So this product started end of 2023. I would say during the course of 2024, that is when we started basically financing projects. And if you look at the portfolio now, we are around $40 million in terms of approved loans and projects that hopefully will materialize throughout the course of the year. I can also mention some other interventions that we are doing in terms of blended approach. We have the Renewable Energy Fund that has contributed significantly to the electrification of the country, from 10% electrification in 2015, in 2010 to currently it's around 82%. And it also has different donor funding and also public funding. We were able to mobilize up to $217 million through debt, and grants. So it's a typo, and also provide subsidy for the end beneficiary. So, and when it comes to also there's the REF project and EQUIP project. So the energy access and quality improvement. So these are the distribution of clean cooking stoves that also were able to mobilize up to 150 million from private sector. And the approach is mainly result-based, whereby we have the value chain in terms of unit distribution, and then they that are financed different on the impact and also verified impact. So the main funders is the Government of Rwanda, BRD, AIB, the World Bank, and we have the EDCL, is the National Energy Development Corporation that does the monitoring and verification. So when it comes to the PPPs in terms of energy projects, so in the case of BRD, we were not able to be part of any financing any PPP, but we do have some PPP projects in Rwanda, starting with the biggest one. We have the Ruzizi 3 hydropower plant. It's expected to do between 147 to 206 megawatts, and it's a regional BOT, build, own, operate and transfer. And the key partners and financials, we have the Rwandan government, the Democratic Republic of Congo, and Burundi as the sovereign partners. We also have SN Power and IPS that are making up the Rusizi Energy Limited IPP. And in terms of the funders, we have AFDB, EIB, World Bank, and KfW. So these are examples of the PPP projects. And most of the renewable energy projects in Rwanda are mainly hydro. They account for more than 50% of the energy grid, but we also have off-grid portion through the Renewable Energy Fund that makes up around 21%.
Maybe I can ask the first question then. Yes, you showed a slide where you showed the funders. There was a lot of them, very impressive. Yes. Which ones were the first two?
AFD was the first. Yes.
Okay.
Yeah.
So I did not know this.
AFD and EIB. So the facility was launched in COP27 in Egypt, and that's where we had the initial commitments from AFD and EIB. But the first financing credit line was from AFD.
Just, I mean, we followed a bit on Rwanda, and we know that you've done lots of interesting things, including issuing a sustainability-linked bond with the World Bank, which just to champion that and ask other public development banks to look at Rwanda, because I think that's a great case study. I know we're not talking about that today, but great leadership and thinking from Rwanda on taking that forward in the next step. Just on the guarantees, the bank guarantee, could you explain who provided that? What was it, a sort of funded guarantee? Any more details you can provide, and who was behind it, and how did that change this, the sort of funds you've mobilized? What sort of impact did it have? Thanks.
Yeah. As I mentioned at the beginning of the presentation, so the main issue not only was the access to affordable financing, but it was also high collateral requirements that commercial or financial institutions require for you to be able to access a loan. So with that, the Swedish SIDA provided collateral support guarantee that is first loss to not only de-risk this project, but also make them meet the requirements, the collateral requirements. So giving a real-life example. So the guarantee provides up to 50% loan coverage to these businesses, and to go an extra mile for women inclusion, they provide up to 70% of the collateral support. So it's been instrumental in terms of unlocking financing, but also giving comfort to the bank to further finance these projects. Yeah.
The guarantee is really interesting. So the Swedish Development Agency is a very common issuer of guarantees. We know them well. They are also a member of Convergence. And on this sustainability-linked bond, Convergence did a webinar on that transaction a couple of months back. If your organization is already a Convergence member, you can watch the recording. And we have some information on that transaction as well on our website. It's a really, really interesting example. Okay, we have a question here.
My question would be on the realization of the grants. How do you know around range of the realization of out of the 26 million?
Yeah. So the grant is being mobilized by the Rwanda Green Fund, and roughly I would say from the 26 million, I think about 8 million have been already mobilized, mainly through Danida and also Bill and Melinda Gates Foundation. There's also, I think, there's progress in terms of the GCF grant component that's also been approved through the African Development Bank as the accredited entity. And given the progress, I'd say by beginning Q1 2026, they'll be having it. Yeah.
Thanks, Ali. The reason why I asked this question is because we have like committed financial commitments as well as grants, but sometimes when it comes to the mobilization and realization, it's not spent down that much because we have this like commitment. However, when it comes to the project realization pipeline, the mismatching, it's happening. So yeah, that's the reason why.
Like in the case of the Ireme, it's easier to mobilize the grants compared to the credit lines because of the different conditions that have to be fulfilled. So you would find that some of the funders, in terms of credit lines, have a specific scope in terms of projects that you can finance. So we're also trying to also blend internally in terms of different credit lines that we have in-house. For example, we might blend a credit line to finance a project. We blend from the AFD credit line with the EIB as a sort of, they become co-financials for a single project. So depending again on the scope of eligible projects or investments as per the agreement. Yeah.
Thank you very much. In the interest of time, I think we need to move on, but thank you very much for your presentation.
So I just thought maybe I should just include a slide just to assist some colleagues here, for you to have a high-level understanding of who DBSA is. So we are a development finance institution and 100% owned by the government of South Africa. We are mandated to carry out an infrastructure financing mandate. And I'll go through what we do from an infrastructure standpoint. We pretty much support activities of the government from an infrastructure implementation perspective, but also support other areas from an infrastructure development standpoint in South Africa, as well as the rest of the region as well. What's particularly of interest for this session is our global accreditations. So as you know, we require these in order to have partnerships to allow us to optimally deploy funding to respective projects in the form of debt, and various other debt instruments as well. So what these accreditations assist us with is we are able to mobilize funding that we can blend with our own funding to be able to deploy those financing instruments to provide an optimal funding solution to various infrastructure projects. So we are accredited with the Global Environmental Facility, and that's part of the World Bank, for those of you who don't know. as well as the Green Climate Fund. We also have various other partnerships where we've partnered with, received credit lines, like the likes of the EIB, KfW, and many others. And all these credit lines serve for a different purpose. They all have different criteria, different sectors within infrastructure that they're trying to address from an investment and funding standpoint. So just to go into just further detail in terms of what DBSA does and what activities we are busy with as a DFI. So our approach to infrastructure development is quite integrated. We start the phase of planning, and we move all the way up until implementation. So I mean implementation and maintenance. So our view is more of an integrated approach to infrastructure development and support. And on the planning phase, we pretty much handhold quite a number of municipalities in South Africa to support their infrastructure needs within their respective areas, assist them with planning, infrastructure planning activities, assist them with any areas of weakness such as revenue enhancements, enhancements in collection, etc., because we have a vested interest in the optimal operation of those municipalities because we lend to them as well as a DFI. It's part of our developmental mandate to lend into some of these under-resourced municipalities that do not have any other funding options other than the DBSA. And we work together with them to make sure that the funds are correctly utilized, and also they are placed in a position where they can eventually repay the DBSA. A big area I think that we are actively involved in is the preparation and the finance of projects. I think most of you are familiar with that. And what we ordinarily do here is we assist a lot of projects with last mile development, providing funding in that regard. And a lot of the funding can provide some technical assistance. We also provide funding to support the development of programs, because sometimes other infrastructure leads more towards a programmatic approach in implementing that development of or investment in that infrastructure. And I also have an example as well later on of the success of following a programmatic approach to infrastructure investment and how that can assist in scaling up and mobilizing the respective funds to address the growth of that infrastructure in the country. Financing, we finance infrastructure projects across most of the infrastructure sectors, so it's energy, ICT, we finance road infrastructure, and so forth. And we use all these instruments that are listed here. But what's of particular importance as well is the clients that we service as well. As I mentioned, municipalities are a big area of us because it's a big developmental mandate from a DBSA standpoint. We also support SOEs from a financing perspective, sovereigns, and that's in country as well as outside of South Africa. And then in the private sector, where I'm particularly involved in, since I am part of the project finance team, and we finance a lot of the PPPs in country as well as the rest of the continent, as well as a lot of the private sector projects as well that may or may not interface the public sector. Now, I thought I would put this in because it just gives you a bit of a snapshot of the various sources of funding that we've been able to mobilize to support our climate finance and environmental finance initiatives. And a lot of this is also leveraging off the accreditations, it's leveraging off the relationships that we have with various key stakeholders. What is of particular of interest here is the green fund. I have my colleagues here from the climate finance unit. They work quite closely with some of these sources of funding that are used to blend with our normal sources of funding to deploy funding into infrastructure projects. The Green Fund, that is a fund that we manage on behalf of the Department of Environmental Affairs, and it is geared towards supporting climate and environmental initiatives. Sorry? Oh, a mic, okay. No, my colleagues are right here because they are much closer to this fund than I am. Thanks.
So this fund was established back in 2012. It was probably our first, so we've supported obviously renewable energy projects for quite a long time, you know, way before establishing all these dedicated facilities, you know, obviously the REIPP, the Renewable Energy Independent Power Producer Program. But the Green Fund was kind of the first dedicated facility to support South Africa's kind of transition to a greener economy. So at that time, you know, a lot of things were fairly new in terms of the policy environment. So we did a lot of research. We used to actually publish policy papers across different sectors, you know, around green transport, you know, other specific areas that talks to the green economy. So that was the first phase of the Green Fund, where the R&D focus was also looking at new technologies, supporting the green economy. But since then, the Green Fund is now firmly embedded within DBSA, and we've decided to now focus more on on specific projects. So we don't do as much the R&D stuff, but we do still focus on innovative technologies as well. But the 16 R&D projects are what we supported in the let's say first phase of the Green Fund.
I'm going to move on because we time sensitive, because I just want to focus on some of these slides that I've got here as well. This is quite a recent structure that we had put up from a blended financing perspective. We partnered with the Green Climate Fund. So what happened was South Africa went through quite a transformation in the energy sector. We have an act called the Electricity Regulations Act, and that pretty much governs the registration, the licensing of energy generating facilities. It also governs the ability of energy traders to operate within the country. Now, there was, you know, the renewable energy sector in South Africa was pretty much driven by the government procurement program, right? And a lot of the licensing requirements were done through that act called the Electricity Regulations Act. We call it ERA. And over time, the government saw it in terms of meeting its targets from a renewable energy investment standpoint. They saw the regulations as quite inhibitive in terms of you know, expanding the investment potential in renewable energy. And so it went through a transformation where from having quite rigorous licensing requirements for energy generating facilities, it went through over a period of 3 years to actually opening up the sector and allowing energy generating facilities of any size to not require a license, but rather require a registration with the regulator. And that really eliminated quite a lot of red tape in terms of energy generating facilities actually now getting invested in the country. And what was happening was that there was a lot of projects that were ready, have been developed, but were never awarded through the procurement program, maybe because of the tariffs, etc. So there was a lot of supply of projects. And this was an opportunity for these projects now to enter into the market, not only through the government procurement program, but rather through the private sector, where now they can actually bilaterally contract with the commercial and industrial sector to enter into PPAs with their respective IPP projects. So what we saw was that it was an opportunity because the biggest, I think, stumbling block with these projects was that they did not have the cushion of the government guarantees. Now, the public procurement program, all those projects benefited from a government, an explicit government guarantee that was provided by the government. Now, you want to enter into a 20-year PPA with the private sector, what do? Your financing structure is not going to be the same as what you would have had in a public procurement program project, right? So we saw this as an opportunity to try and enhance the capital structure of those projects by introducing a first loss tranche, which is what this is showing you. On the left-hand side is your normal, typical project finance structure that you would find in a government-supported project. And then on the right-hand side, we saw it as an opportunity to enhance the capital structure, but enhance it providing concessional funding for that tranche to enable to crowd in the senior debt and commercial lenders to fund into the senior debt to enable the implementation of those projects. So in doing this, we engage with the GCF, and we partner with the GCF, and we eventually managed to implement a program called the Embedded Generation Investment Program, which we coin as Egypt. Now, we've done something similar as well with water reuse, exactly the same, because what we realize is that municipalities also want to invest in additional infrastructure, but they don't have, they can't give guarantees, for their concession agreements. So we've partnered again with GCF on the water reuse side to enable the crowding in and the financing of these projects. I mean, right now in South Africa, this market has become so mature that lenders are pretty much reducing the subordinated tranche to quite a minimal level now, because of, this was right in the beginning of all of this. Now, lenders understand the risk they are taking, know how to adequately allocate the risk and mitigate for that risk to enable to reach an optimal financing structure for those projects. And lastly, I just wanted to give you a snapshot of the Renewable Energy IPP program that South Africa is quite well known for in terms of increasing the investment in renewable energy projects. To date, this is from, I think, from the IPP. So we've got an IPP office that manages this entire procurement program. And these are figures from December 2024. And if you can see, all the figures are in South African rands, but in total, there's about, I think, 16 billion US dollars that has been mobilized, right, for these projects to reach financial close. So we have that many projects, about 7 gigawatts of projects in operation, renewable energy projects that have been constructed and are operating as a result of this procurement program. Now, a biggest area I think that the government is now working on, and if you can see here, bid window 7 is the latest bid window that the government embarked on in procuring some additional energy capacity from renewable energy. And as you can see, the intention was for them to procure 5,000 megawatts. They were only able to procure 1,760 megawatts. They couldn't allocate the rest. And the reason being is that there was transmission infrastructure, grid problems. So we have a huge gap in that regard. And I think for us as a country in South Africa, that is the next area where a lot of funding needs to be mobilized, and in order for us to come up with blended financing solutions to invest in transmission infrastructure. So this is a huge area for the government at the moment, because we're not going to get additional capacity at the scale that we want from a renewable energy standpoint if our transmission infrastructure is not deployed. So we have this grand transmission development plan that seeks to deploy 14,000 odd kilometers, but it's quite a tall task, and it requires a lot of funding to be mobilized. We are working with the World Bank in coming up with a credit guarantee vehicle. So our national treasury has partnered with the World Bank. And because of constraints from a government standpoint, they can't keep on providing explicit guarantees to projects of this nature. So that credit guarantee vehicle is meant to assist in enhancing the credit enhancing the contracting arrangements for investment. I mean, that infrastructure investment. I'm so sorry. I'm done. Thank you so much. Thanks, everyone.
Very interesting what you said also about the blended finance element, where you said, now the market is fine and now we're reducing the subordinated loan, because that's the idea, right? In the end, especially in such a mature market like renewable energy, more mature than at least the nature-based solutions, for example. The idea is that blended finance is a stepping stone in order to reduce that gap between perceived risks and real risk. And once the private investors and the commercial banks realize it's actually not that bad, once they have a little bit of track record and some data to prove the next investment decision on, that's when you can reduce the concessionality without any problems. Let's have some questions. Please stay with us for a little while.
One on the subordination, because this tool or instrument that you presented to us is obviously the answer to what we saw yesterday. Then were you subordinated in terms of repayment or in terms of security or access to the securities? Then what was your subordination in what you offered?
Oh, thanks. So it was both what you mentioned. So we were second ranking to senior lenders, but what we did is that we do take a little bit of a tranche in the senior facility, and what that assists us as well is, in terms of the intercreditor arrangements, we are also around the table when senior decisions are being made, etc. And then from a subordinated debt perspective, we also are second ranking from a security standpoint as well. And one thing I didn't mention is that we've also played a key role in, I think you saw in one of the slides, is that we've supported, so part of the imperatives of the program, the Renewable Energy Procurement Program, was to ensure that there's local participation in the shareholding. Local community trusts have shareholding in some of these projects. So we actually funded the equity of those local shareholders and local community trusts. And so in there, we were even third ranking, because we rely on the distributions to repay us. Some of those local community trusts has fully paid us, and all the funds are now, all the distributions are going towards the investing activities in improving the lives of those communities where those projects are located as well. Thanks.
Any other questions or comments?
Sorry to ask another one, if I may. Just a question, I mean, was this done in local currency? What was the sort of impact of that in terms of the guarantee? And yeah, any insights on doing it in local currency against USD?
Thanks. South Africa is quite a unique country. For those of you who are not familiar, it's one of the few countries on the continent where there's actually funding in local currency, and the markets are deep enough and there's enough liquidity to support funding in local currency. So even private investors, we have the likes of Angie, many other big utility companies that have invested in South Africa and and all the debt is in South African rands, as well as the cash flows are also coming in South African rands. So that really assists because of the mature capital markets that the country has. On our side, we do raise some capital funding, concessional funding from in euro, in USD, etc. But I think there's enough concessionality in those credit lines to still support local currency funding at a concessional level as well. Thanks.
If I can.
Yeah.
Yeah, so some of these facilities are also financed or co-financed by the Green Climate Fund. The Green Climate Fund provides project and credit, takes project and credit risk, but doesn't take FX risk. So we had to go through an exercise led by Lungile's team to see how we can access this funding, especially for the renewable energy market. It was a long exercise with the Green Climate Fund, I think around 2.5 years, whereby we then said a model that will work, which we'd actually proposed initially to them. A model that will work would be a credit line to the DBSA. The DBSA has extensive experience in managing Forex, and we will provide local currency to our borrowers because we just understand the local financing landscape. The banks, the financial institutions, nobody wants any project to be exposed to extensively through borrower FX risk. So we found a modality with that, especially as well the other interesting, the water project, the adaptation project we just structured. There we actually, GCA was really quite innovative, but involving our treasury unit extensively being involved. They're actually taking FX risks, but they'll never admit it. So it's very innovative, and the information is actually public. I can show you where it is in the funding proposal, so you can actually look how it's done. But yeah, they've bespoke. They will take credit risk, but there's still a matter of hedging that's required as well. But I think for our markets, for what way we operate in, we need to provide financing in local currency as well. Thanks.
That's a very interesting example. I do think that should enter the reading materials or share drive or whatever you have. And also it's good for you all to know, because if you ever face the same issues, maybe you want to give a call to your DBSA colleagues and ask how they've done it, so that you don't take 2.5 years to negotiate. Because that's the idea, right? Like for the first mover, it will take a while, but hopefully the next development bank that works with the same entity will not be. And I mean, in some parts, you would hope that GCF would then proactively propose the same arrangement to another bank. But who knows? Maybe the GCF person has since left, right? So in that case, it might be more helpful for you as a bank to talk to the other bank and then be able to work around. Institutional knowledge is an important one.
Hello everyone. So maybe a few words about Mirova first. So we are one of the largest impact investors worldwide. We manage 35 billion of assets, all impact investing, all SFDR 9 for those that know the EU regulation. We are one of the pioneer and historical actor in clean energy financing. The first worldwide green bond fund was launched by Mirova. The first largest European transition clean energy fund was launched by Mirova. And we are also very active in biodiversity. That's something I will not detail today, but we have close to 2 billion of assets under management in biodiversity. When it's come to blended finance, actually, Mirova started blended finance in Europe a long time ago, at last century. I mean, the fund was closed in 2002, but it started before, to develop, with the support of a French NGO governmental agency named ADEM, a first time ever fund that was financing renewable energy in Europe, mostly wind, through a blended finance structure where this organization was taken the first loss. Obviously, after a couple of years, it became clear that you could finance clean energy in Europe without blended finance structure, so the second fund wasn't blended, etc. And today we are launching, I mean, we have 6 funds active in clean energy in Europe. They are not blended. The fund size is large, 2 billion of assets each, and you have plenty of institutional investors that invest in non-blended structure. Why I'm mentioning that is because we do a blended finance fund only if we believe that the risks are too high to put mainstream institutional investor into a normal fund, I would say. That is why if you look at our 35 billion of assets, only small part of it is blended finance, that is to say 2 billion. The rest are non-blended, where a private investor could invest. And for instance, it means for us that clean energy, if it's in Europe, in the States, or in Australia, we do it non-blended. If it's Southeast Asia, we have to see what kind of fund you do and where do you finance. Typically, if you do commercial industrial rooftop equipment in Southeast Asia, you don't need to blend it. For Africa, it's a different story, then we go blended. Biodiversity, just a few words, because you are interested maybe by biodiversity as well. Out of the 6 funds we have in biodiversity, as of today, only 1 is blended. We are launching now a second blended finance fund to do credit carbon, but for instance, it will be our 4th credit carbon fund, and the 3 first were not blended for various reasons. The 4th one will have to be blended. So each time we launch a strategy, each time we launch a fund, we ask ourselves, do we need to blend it or not? What are the risks we have to cover? Is it something very pioneer, very innovative, where it's better to protect private investors? Is it something where we believe we have a bit of risk? Maybe 2 things that could be of interest for you. We are deeply involved in some network like Convergence or ILM. ILM is a network of a large institutional investor worldwide, and we are leading there or co-leading together with CDPQ, the blended finance platform. And as you could see, we developed mostly blended finance funds in the last 10 years with the acquisition of 2 companies, Altelia for everything related to biodiversity 10 years ago, and Sunfunder 4 or 5 years ago for clean energy in Africa. And roughly every other year, we launch a blended finance fund, sometimes twice, 2 funds per year, in clean energy or in biodiversity. We are doing, for instance, this Friday, you may see a press release, the close of our Mirova Sustainable Land Fund 2, one that does sustainable agri and sustainable land, globally, global soft, with FMO, Proparco, and many other organizations joining us for this fund. I wanted to say a word here. I thought I had a slide, but I don't. We also, in blended finance, have a research center. We are sponsoring an academic research center with Columbia University to work on blended finance, and more particularly to fine-tune a bit how much of junior you need to cover potential loss that will come in a blended finance fund, because that's a topic we see a lot of funds that are overprotected, which is a problem for us, because we usually, the issue we face when developing those funds is to find junior investor at scale. And when we see some funds that are overprotected by some DFI, for us it's a pity, because it means we will have less funding for our own fund, why we believe they shouldn't have invested in other funds. The truth is that convergence database, for instance, is very great, and we are part of the network, we use it a lot, but there's no statistical evidence of how much junior you have to put if you develop, for instance, a decentralized clean energy in sub-Saharan Africa. What is the level of junior you have to put? 10, 20, 30? What is the historical track record of this sector? So that's what we aim to do with Colombia. The partnership just started. It's a 5-year program. And we are already including several different organizations. And we hope this will facilitate, obviously, the development of the blended finance industry. Quickly, so 2 strategies where we do blended, that's the 2 strategies where Mirova is globally involved, energy transition and sustainable land, sustainable agri, biodiversity, basically. When we do that, just few words about the impact. It's not only climate, it's obviously firstly climate. We want, by investing in clean energy, for instance, to reduce the emission of CO2 emission. It's mostly CO2 emission avoid by replacing genset functioning with oil or coal or whatever with solar one. But it's also a lot of social and economical outcome. We believe climate change could happen only if social and local community are involved. So that's why we also have always metrics that target smallholder farmers, vulnerable population, gender issue and the like. And they are for us equally important actually than the climate outcome. So I will detail more particularly the 4th fund we developed for financing decentralized clean energy in sub-Saharan Africa and in this time for Southeast Asia, a fund that we closed in 2023, so 2 years ago, but still fundraising. Historically, we have been involved in financing decentralized clean energy in Africa, so solar home system, 10 years ago, then we moved to commercial and industrial rooftop equipment, agri-solar and water pumping in 2017. We did one of the first transactions to finance the solarization of a telecom tower in Republic de Centrafrique in 2017. And gradually we include new sectors. So as of today, for instance, we finance also battery storage, e-mobility, cookstone, and many other sectors in the region. With this fund, so the first fund, the Gigaton Fund, the objective was to scale. In our DNA, we always have to innovate, new sector, new technology. So here it will mean, for instance, battery storage, e-mobility in Africa and the like, but also to scale with our existing partner and, for instance, to finance. The map is wrong, actually, because we do finance CNI, for instance, nowadays in South Africa, and to help people to scale in such markets. So the way we design this fund is that we assess the pipeline, 400 million basically we could deploy in the 2 regions. We decided to concentrate most of it in sub-Saharan Africa. That's where we are historically, through an office in Nairobi where we have 20 investment officers that look at this market, but also to expand in Southeast Asia. We have an office in Singapore with 12 investment officers as well. And when we designed the fund, it was our 4th fund, so we had the track record of the first 3 that were sub-Saharan only, gradually moving from solar home system to CNI, to agri-solar equipment, to telco, to e-mobility, and the like, and to assess what will be the level of junior tranche we need. And also, we wanted for the first time, for us, and probably for the industry, to attract also private institutional investors at scale to finance clean energy, decentralized clean energy in Africa. In our first 3 funds, we had private investors, but they were pure impact players. Family office involved in impact, a couple of banks that are really impact driven, not the mainstream asset manager. So we wanted an asset owner, so with this fund to attract private investor. And for that, you need a fund that is above 300 million. You don't have a European private investor or an Asian one or an American one that will look at a fund below 300. 300 is the minimum. really the minimum. And for instance, for this one, we had a couple of private investors that declined, saying the fund is too small. We could start only at 500 million. And it's true that, for instance, even in emerging market, we work with MAS, the pension fund of Singapore. And when they work with us, they give us usually a mandate of 100, 200, 500 million. The last mandate we signed with MAS for energy transition was 500 million. So 300 million is too small for them. They will look at the fund only if it's above 1 billion. But pipeline-wise, we could not develop something more than 400 million with this one. So what we did? We structure it in 3 tranches. In natural capital, we have usually only 2 tranches, junior equity and senior equity, because we finance project finance in biodiversity and agri and the like. Here we move for 3 tranches. So a junior equity, a mezz debt that we call senior, it's a bit of window dressing for the DFI, and the super senior one. Why we put it senior here? Because it was the first time we were able to have DFC and Sweat Fund investing in the mezzanine tranche for financing decentralized clean energy in Africa. In our first 3 funds, where they were, DFC and Sweat Fund wanted to be in the super senior tranche, in the most protected tranche. With this one, that is why we call it senior, they move a bit down the slack, but still they wanted to be protected. So we calibrated the junior tranche at 15% based on our historical track record, and also, to be honest, with what those development finance institutions were looking at in terms of protection. In most of our funds, we have 2 options with the DFI. Either we group them with the private investor in one single senior note tranche, or we have a mezz, but then we need government agency and foundation to protect them. So here, together with them, we calibrated that we needed 15% of protection. And one innovation that we did, it was the first time it was done like that, is to discuss with SIDA, Swedish International Development Agency, that you all know well. And for the first time, they agreed to provide a guarantee at the fund level, global, that could be included exactly at the same level than the catalytic junior. So the subordination ratio of 15% combine junior equity tranche plus SIDA guarantee, and it's including in the legal documentation of the fund, and it was accepted by CCSF and IMF, the local authority, as a protection towards the other investor. And no SIDA, because this was designed in 2022, has experienced that with many other funds, I think for the benefit of the industry, because then it's enable you to reduce a bit the level of junior catalytic capital you need, which is obviously the most tricky part to find. Because either you work with GCF and organization like that, and you could not develop it throughout a continent like Africa. As you could see, we are active in 26 countries in Africa, and it's impossible for us to get 26 agreements from non-objection letter from local country with GCF. Maximum we could get here is 5. For instance, South Africa, we try with our biodiversity fund that exists, where we have a green climate fund agreement, 70 million. We try to convince the South African authority, sign the non-objection letter so that we could deploy the fund, and they say no. And plenty of reasons, and it happened very frequently. So that's why GCF for us, for instance, is an option only if you work in a couple of countries, but it contradicts our philosophy, which is to have large funds, meaning you have to be in many countries, diversify, private investor-like diversification. If you are not diversified, they will not invest. And also globally diversification among sectors, so GCF may favor one sector or the other. So this fund was launched 2 years ago. We already have deployed more than 150 million of portfolio in Sub-Saharan Africa and Southeast Asia. Couple of innovation as well is that we try to get a rating of the senior tranche, I mean super senior, highest tranche. Was not possible to get an investment grade rating. We may have been able to obtain a rating, but non-investment grade because of a couple of factors. One of them is the usual delegation of governance plus acceleration right that development finance institutions are asking for, particularly related to compliance, that makes this mezzanine tranche not recognized by the mainstream rating agency as a true subordination. As you know, a rating agency apply Basel III criteria, and in the industry, be it DFC, be it EIB, be it Proparco, the way they phrase the subordination is the fact that it's not a true subordination, and as such, mezzanine tranche are usually not recognized by rating agency, at least the top three, Standard & Poor's, Moody and Fitch. You may have some delegation if you work with local one, like a credit reform in Germany or scope in France. It may be a bit less sensitive to that, but main one, surely the way today the acceleration are delegated to development institution, make it impossible to recognize this mezz tranche. So basically, when we did the exercise with the rating agency, it ended up by that we have the equity, junior, they recognize, CDR guarantee, they recognize, because the Swedish Development Agency, AAA, very long track record of guarantee activating, this is fine, but this tranche and this one were considered as one single, a bit as we work in biodiversity, so better to have one single tranche, and as such, no specific capacity of get an investment grade rating, because with those protection, we were ending up only in B+, because of the portfolio, so not surely far from investment grade. Still, we were able to fundraise as of today 70 million in this super senior tranche, a bit below our target. One explanation also, interest rate increase. The fund was designed mid-2022. By then, interest rate increase, so we ask ourselves whether we should reshuffle all the fund structure, give more return to everyone, also have more return expectation to the investee, the portfolio. And actually, if you look at Africa today, one of the challenge we have is that definitely it's quite a price-sensitive industry for decentralized clean energy. Let's be frank, how competitor are you in the room? Usually when we lose a transaction, it's towards the DFI that offer a cheapest rate than us or longer tenor. Sometimes DBSA, but not so often actually. Usually we are together with you. And that is why when we look at the balance sheet of the Gigaton fund, if we would have decided to give more return to our private investor, we would have surely been not competitive in Africa. In Southeast Asia, it was fine. The market is giving you more return for less risk. But in Africa, you have to accept today that this is relatively a sponsor-driven industry where portfolio could be deployed after some effort and at rate that doesn't reflect the risk that a normal commercial investor will take. For the benefit of the local investee, I think all of this is fine. So we decided not to increase interest rate, and that's why the fundraising of the super senior tranche was done. On top of those two, you have also two large family office. So mostly private family office, not so much private institutional investor that were the initial target. You see the matrix, impact, energy access, it's one of the key, climate, gender, economical development. I detailed that before, nothing really challenging for us. I would say it's not challenging to report on those metrics. I mean, it takes always time, but today you have the capacity to calculate the CO2 emission avoid if you implement Cookstone or a CNI or an agri-solar equipment in Africa. Metrics exist, they are not so much challenge. You have to indeed make you statistic calculation evolve every year, because every year or every 2 years you have the national NDC that change, so you have to see exactly how the electric mix have changed in the country, but statistics are available, and be it in Kenya or in South Africa, you could find that. So it's obviously to report on those metrics is not so challenging for us. We have technical assistance facility where we could help our local investee to report on them, but that's not the main challenging we have. While designing the fund, actually, do you have 2 slides or 1? Yeah. The success factor for us were we had the track, we had the team, we had the fund. We wanted to have something relatively standardized in terms of offering, both at the fund level and at the investee level. I didn't mention it before, but we finance those decentralized clean energy projects only in debt. We decided to focus the fund in debt only and not to mix it for equity on the portfolio side. That may make the offer possibly a bit more attractive, but a bit more less standardized, so very standardized offering. We reshuffle the structure of the fund a couple of times during the process between June 2021, when we had the first financial model, to June 2022, when we had the final one. We play with the ratio, we play for the interest rate increase environment, we reshuffle a bit the mezz. We saw a lot of demand from DFI, so increase a bit the mezz. So during all this time, we were integrating all comment, and after we were fixing it. And then we try to align as much as possible with investor appetite. The challenge we had, warehousing facility, another one I could mention, because we're active in this market. Obviously, during all the time we structure the fund, for us, one of the difficulties is that when we launch a new fund, the previous 3 funds were already deployed or quasi-deployed. So during a year, you try to go as speedy as possible to launch the funds. And we are relatively speedy at Mirova. Usually, we launch a fund in 18 months for blended finance. Some of our competitors, it takes them 3 to 4 years. So 18 months is good, but during those 18 months, what happened with your pipeline? So ideally, we wish we could have, as in Europe, when we launch an energy transition fund in Europe, we have warehousing facility together with Investment Bank, and then when the fund is launched, so we are launching now Mirova Energy Transition Fund 6, a 2 billion fund. We have already fundraised 1.2 billion. On the day the fund is launched, we transfer immediately 800 million of portfolio deployed. And this is strong for the G curve on the return, because in emerging market, because we don't have those warehousing facility, what happened is that we build a bit the pipeline, but we could not commit. So the pipeline on the deployment starts really when the fundraising is done, and you lose 2 or 3% of return. Actually, if you look at the financial model, we lose 2 or 3% of return because of that, and it's one of the explanations why, for instance, at Mirova, Energy Transition Europe, you get 13% of investment of return for investor net. On the Gigaton fund, we'll offer you 5. One explanation is the lack of warehousing. The other explanation is the market, as I was saying. And the third one is obviously OPEX and also fundraising, FX, currency fluctuation. Senior tranche, we are not able to do it. And we are not able to develop a technical assistant at scale. We have some technical assistant agreement, but not exactly at the level we wish. Together with Convergence, we wanted to develop really a strong gender lens investing program, and why we had a lot of interest that didn't materialize. So for the future fund, obviously this could be very useful, but the difficulty is that when you meet an investment bank, they say, okay, I could give you the 300 million of cash, but you take the risk, because I don't know those decentralized clean energy in Africa. I know decentralized clean energy in Europe, so for this one, Standard Chartered, Société Générale, BNP will take, okay, I keep the risk during 8 months, the time for you to fundraise, on the day the fund is launched, I transfer it. But decentralized clean energy in Africa, we had agreement where they say, we provide you the cash, but you take the risk. We could not, as asset manager, take the risk. If the fund is not launched, what we will do with this portfolio? We are an asset manager, we are not a bank. And this is one of the key elements that will help us. The senior tranche, I think in the future, redrafting a bit the agreement, and also including DFI at the same tranche and the senior one, the private investor, we could expect to get one day or the other a senior tranche debt rating. I asked last week at Sevilla both Fitch, Moody's, and Standard & Poor's whether they have already issued a rating on one of the blended finance funds for clean energy, as we did the Gigaton, and they say no. So maybe one day it will come, but obviously we will have to fine-tune a bit those mechanisms. And for you, DFI, obviously, if you could reduce a bit your expectation of acceleration, that will be useful, because you know that if you have Proparco in a MES tranche, then the MES tranche is not recognized by a rating agency as MES. Because Proparco will say, if you're in breach of compliance, we could accelerate in 5 days. So it means you could accelerate immediately and put the fund in liquidation, and then senior investor has acquise. So and this is kind of right, we don't give to private investor. Thank you.